Again, good afternoon. Thank you very much for joining us for today's webinar on stress testing, your best hedge against COVID credit risk uncertainties. My name is Sean O'Brien. I'm the president of QuickRate. I am pleased to be joined today on this webinar by Steve Huntington. Steve, who many of you know or have spoken to about our current credit stress test. Steve is really the one who puts all the pieces together for us. So we have the expert as it relates to our credit stress test. We'll also be joined on the call today by David Ruffin. David, as many of you may know, recently joined us in 2019 to head up a new division at QuickRate called IntelliCredit, where we can do additional loan level credit stress testing. We can perform loan reviews, and have built a software solution that allows you to perform portfolio analytics as well as conduct internal and external loan reviews. Couple of reminders, we are in listen-only mode, so if you have a question throughout the day, just click on those. We'll take those at the end. You can hear us, but we can't hear you, so we'll ask you just to submit questions at the end. We will also provide you a copy of today's presentation and a link to the recording so that you'll have those for reference moving forward. Some of the topics we're going to talk about, just a little bit of the confusion around stress testing and some of the anxiety it creates for a lot of us. We'll talk a little bit about different types of stress tests. Steve will walk you through our new and improved quick analytics credit stress test. We'll talk about your role and options as bankers, and then just talk about ways to enhance what you're currently doing, or maybe what you might be looking to do in the future. And then, as we touched on, we'll take questions at the end. So stress testing, it certainly conjures up a lot of different ideas and conversations when you bring it up with bankers. It's certainly not a substitute for your initial underwriting and servicing, but it does have kind of at its foundation, some what if and projection of types of scenarios that we want you or we think you should do and create to get a sense of where you are in potentially stressed scenarios. It gained a lot of focus and attention coming out of the last crisis, particularly the OCC. Was really after banks to stress test. A lot of the focus was initially on the DFAST banks and the CCAR banks, the larger banks. But there was this movement more towards stress testing and enterprise risk management that regulators started to encourage banks to look into. As a result of the more recent benign activity, it lost a little bit of its momentum. But now, with the current uncertainty caused by COVID, it is reappearing as as a recommended and suggested exercise that banks focus in on, because again, at the heart of stress testing, what you're trying to identify, what the regulators are trying to identify, is what will your bank look like in terms of capital if we have heightened losses in the industry. Some additional things. And sources of confusion can often lie in the fact that because there's really no regulatory mandate or prescription, it often falls to the bank to decide what type of stress testing they should do. And again, that leaves many choices and options available to them. We do, heading into 2021, while we think there'll be a focus additionally on stress testing and enhanced loan review, we anticipate seeing that continue as we move on through the year. The bottom line, though, good news for you as a bank is the right choice is really in the eye of the beholder. Plenty of banks like to do things at the loan level. We certainly believe the easiest way to start is at the portfolio level, and that's why we designed the test we have done. But again, it affords you many options as you consider your stress testing. As I mentioned, some of the confusion lies in the fact that there are different types of stress tests. Again, depending on whether you do something at the portfolio level or the loan level, you could focus in on any one of these particular categories or incorporate them yourself. Some banks look to do stress testing on their own. Some look to do it as an addition to or an enhancement to loan review. Some folks do sensitivity stress testing by changing, maybe values to collateral or changes to operating income. So there's a number of different ways that you can do it. Again, ultimately, you have to decide what's best for your bank. These really boil down to, kind of a top-down and a bottom-up approach. Our portfolio level test obviously is a top-down type of approach, but neither way is, more right than the other. It's really, in my mind, kind of a starting point, and then depending on your situation, a regulator may ask you to pivot a particular way. If you have a high concentration, just stressing that one particular piece of the portfolio might be enough. And at this point, I'm going to turn the presentation over to Steve, and he's going to walk you through our stress test. Steve,
thank you,
screen is yours.
Thank you, Sean. Good afternoon, everyone. Give me one moment. All right, everyone can see my screen now. So our stress test, we create 3 completely separate but very similar tests. The first test is what we call the peer group loss experience. And in the peer group loss experience, what we're doing, in effect, we are aggregating the loan loss histories and experiences by loan category for every bank in a peer group. And then we are taking those loss rates and we are applying it to your bank going forward. So we are trying to answer the basic question: if your loan portfolio, the way it's currently structured, if it were to perform going forward over the next couple of years, like your peers did in a variety of different economic scenarios, healthy, unhealthy, and worst case scenario, what would be the pro forma impact on your P&L and on your capital? And then we perform a second test called the bank historical loss experience. Now, this second test has all the same steps, all the same methodology. However, we ignore your peers' experience and we just look at how you fared during a variety of different historical environments, healthy and unhealthy and worst case scenario for you, and do the same thing. We apply that to your current portfolio so we can answer a similar question: if your portfolio were to perform going forward like it did in the past, what could be the pro forma impact on your income statement and on your capital levels? And then finally, we perform a third test called the reverse stress test, or some people call it the break the bank test. I finally refer to it as the how much rope do we have to hang ourselves with test. Now, the name, the reverse stress test, is a pretty apt name because we are really taking all those steps that we perform in the first 2 tests and working them backwards. Instead of calculating loss rates and then using that to reproject income and then using that to finally reproject capital, we start at a set capital level, let's say the minimum to be well capitalized, and we work backwards to calculate what levels of losses could you sustain in your portfolio over the next couple of years before you were to drop below either any internal target capital minimums that you have, or below those PCA thresholds for well capitalized or adequately capitalized, or even drop below the if you fill out all the regulatory capital ratios and you're not a CBLR institution, the capital conservation buffer. So that's another good ratio to know how much buffer you have before you started running afoul of that minimum as well. And within, again, as I already sort of alluded to, in each of those first 2 tests, the first step is to re-estimate loan portfolio losses. The second step is using that to reproject your income statement. And then the final step is using that to reproject your capital. So I guess with no further ado, we'll get into the live demo and we can walk you through our interactive credit stress test. For those of you who are not current users of our stress test, we have had a credit stress test for a few years on the platform now. It had a handful of inputs, and it was sort of presented as a PDF output tool. We have made a number of enhancements. We've gotten a lot of user feedback over the last few years, and especially over the last few months, about improvements we could make, and we decided to kind of put them all into this newer interactive version of the stress test, which I'm about to give a demonstration of. You see here just sort of a screenshot of it. One of the big enhancements is that the entire report is run is in an interactive environment. So it's all run the second that you log in with default assumptions. The entire stress test has already, in effect, been performed behind the scenes. So you have actionable results sort of right out of the box. And the only heavy lift, I wouldn't call it heavy lifting, but manual labor required at all is to modify the assumptions if and when you find it necessary to do so. So you can see the results of the changes to any of the assumptions or inputs in a real-time environment, so you can very easily spot, so to speak, what's going to move the needle from a loss perspective and a credit perspective. So let me drag over my live browser window now. Right, if everyone can see, this is as if I have just logged into my new into the credit stress test. This new environment, we have a few options up here for seeing the test results, customizing your inputs, and again, we have those 3 tests that we had discussed earlier: the peer group loss experience, the bank loss experience, and the reverse stress test. Let me take just a moment, focus more on our existing credit stress test customers right here to just discuss a couple of the new enhancements that we've made. And if you're new to the product, you'll see these over the next few minutes as I walk through them. But just to sort of enumerate some of the bigger enhancements, in addition to it being in a more real-time interactive environment, we have increased flexibility with the projections and increased granularity with the loan portfolio. Our forward-looking time horizon is a 2-year or 24-month forward-looking time horizon, and now it's split between year 1 and year 2, so you have a little bit more precision in seeing your projections over time moving forward. Critically, for those of you that have PPP loans or COVID loans, we've added in the ability to customize your current loan portfolio so that you can exclude PPP loans, or really, honestly, any government guaranteed balances that you have, whether it's a forgivable loan like the COVID loans, or whether it is an SBA guaranteed balance. And you can do that by loan category so that you can more accurately reflect the loss liability in your current portfolio. We also have added in a lot more flexibility in customizing the look-back periods. You can more precisely define what you consider your baseline or healthy, unstressed time period, as well as your more adverse and severely adverse time periods. We've added a couple more options as far as the ability to set your own internal capital minimum targets. You'll understand what that means as we're walking through the reverse stress test in a little bit more detail. And we've added in the ability for you to project, to plug in future capital raises and see sort of instantaneously what impact that additional capital would have on the future stress scenario. So you could kind of do a bit of some more what-if scenarioing and see if your capital drops below a certain threshold, how much capital would you need to add in order to get back above it, and then you could rerun the stress test with that additional capital to verify that you now stay above some of those internal targets or regulatory targets. And from an administrative or management standpoint, we've created the ability for you to save all of the inputs. Now that we've given you more flexibility and customization, we wanted to make sure that you could save all of these in scenarios, so you could create as many and save as many different scenarios as you'd like. And we still retain the ability to export the tool to PDF and to an Excel environment. But let's dig into the details for a couple of minutes here so we can see how the test actually works. So again, as soon as you log in, the test has already actually been run in the background. So you can see a couple of the executive summary pages right here up front, where we can see in the various scenarios, wherever we present the scenarios, we always present them in a color-coded, easy to follow, side-by-side fashion, where we have baseline in green, the adverse scenario in orange, and then the severely adverse or very much worst case scenario aptly color-coded red. And we see losses ramping up as the scenarios become more punitive. earnings dropping down, and then capital ratios all reprojected out into the future. So before we walk through the results, which we can see here as we toggle through the different pages, let's take a quick look at the inputs. So when we click on our customize inputs, it's going to ask us very much like it does in the current product with just a little bit more detail. We need some help in having you guys help us project your net interest income and your fee income and overhead expense. You know, we are going to be reprojecting the credit parts of your income statement, like your loan loss provision and your OREO losses, gain or loss on sale of OREO. But these other items we don't have direct access to and any idea what you might want to plug in projection-wise, so we leave that up to you. You can run it currently, or of course you can run the entire stress test as a previous point in time if you wanted to go back in time and run it, for example, as of the end of 2019. If, for example, you are a CBLR, if you've opted into the community bank leverage ratio framework and are no longer filling out, you know, total risk-based capital and risk-weighted assets and some of those items, there are certain parts of a test which will work a little bit differently and be slightly more limited. So if you wanted to go back in time to before you were filling out CBLR and run the stress test as of then, you could do that. So some flexibility as far as when you run the tool. Here is what I was referring to earlier as far as additional new functionality to customize the loan portfolio. So we show you what your current loan portfolio is, you know, having from call report at least values, but we allow you here to exclude all of your PPP loan balance by loan type. We have the total balance down here from the call report, but you can fill in these individual loan type balances for PPP loans and then for any other government guarantees or adjustments here. So we have an adjusted, more accurate balance for your loan portfolio to use in the analysis. And then finally, the other assumptions, these are again newer functionality where you can plug in an internal minimum target for either whether it be, you know, let's say, you know, CCB minimum of 10.5% for total risk-based capital, or if you have a tier 1 or CET1 or leverage ratio that you'd like to run the test, the reverse stress test against, you can plug those in. And here is where you can actually plug in projected additional capital raises, whether it's common stock, tier 1 preferred, or tier 2 preferred here. And you can do those in either year 1 or year 2 of the analysis. Other big important parts on the input side is to get an idea of what those loss rates are historically. Right? So let's start actually with the peer loss rates. So the first thing we have to do here is establish, choose, build a peer group. By default, we just have your standard UBPR peer group here. This is a pretty large community bank up in the Northeast. They're in UBPR peer group 3, so by default, we have them set up for UBPR peer group 3, but you can choose any one you'd like. Or you can limit your peer group to community banks within your state, or you can build a completely custom peer group and run the stress test against that completely custom peer group. And I would highly suggest that that everyone takes advantage of those custom peer groups for credit stress testing, specifically for this type of a product, because of the very real reason that, let's say this is a $1 billion community bank in Maine. They don't really care how bad CRE lending got in 2009 in San Diego. What matters to them are the types of loans that went bad in their market, in their neck of the woods, how bad they got, and when they got so bad, whether it was the earlier part of the cycle, 2008, 9, and 10, like some of the banks on the West Coast, or whether it was more 2011, 12, or maybe even 2013 in places like Georgia and on the East Coast. But once you have built a custom peer group, you can see down here is where we can look at these your loss rates. And under a baseline scenario, we're looking at recent loss rates during a healthy environment. By default, we have the last 4 quarters in here. But if you wanted to expand it and say I wanted my default or my baseline period to be all of 2019 and maybe exclude 2020, you could. And as you change the look back period here, you'll see the these blue bars representing that look-back period, shift in real time, and the loss rates, those historical loss rates, all recalculate again in real time. After establishing a baseline scenario, we're also going to want to establish those adverse scenarios. And by default, we define the adverse, the last stress scenario or period as 2009, 10, and 11. For most parts of the country and most peer groups, that's pretty accurate. That's what we have in our current stress test. So if I scroll on here and take a look, I can see, yep, those 3 years were the worst 3 years during the last credit cycle for net charge-offs, at least on the whole portfolio, 2.69%, 2.31, and 1.55. But we allow you to, again, modify that stress period if you want to, just by simply dragging the bars there. And we also have added in the ability to stress different sections of the portfolio to a different degree. By default, in the adverse scenario, the regulators sort of require that they want to make sure that your capital could withstand it if you performed not just as bad as the average bank did during the last stress period, but actually worse than the majority of your peers during the last stress period. So not only are we choosing kind of a very punitive time period historically for our adverse and severely adverse scenarios, but we want to look at maybe not median loss rates, but 75th percentile or 90th percentile loss rates. So by default, in our adverse scenario, we use the 75th percentile loss rate, and we do that across the board for every loan type. If you wanted to make the scenario more punitive, you could change this to, let's say, 80th percentile across the board, and then boom, boom, every number you see on this screen just recalculated for every single bank in UBPR Peer Group 3 across the country. So a huge amount of number crunching and calculations going on behind the scenes, but to display some pretty straightforward numbers, the 80th percentile loss rate during the last credit cycle for the peer group being UBPR Peer Group 3. You can fine-tune this at the category level if you want to be a little more or a little less punitive for a particular loan type. Let's say for your multifamily resi, you wanted to be a little less punitive and you made it 60th percentile. So all of these rates here for resident for multifamily are going to recalculate at the 60th percentile during the last stress period, and it recalculates that those calculations. And for the severely adverse scenario, we're using the same peer group, we're using the same loan types, we're using all the same information. We're really just calculating a more punitive percentile rank, so the 90th percentile loss rate for each loan category during each of these 3 years during the stress period. So you can see at the 90th percentile, the loss rates were pretty crushing across the board during the last cycle for very large community banks in that over $1 billion size range. Now, clicking back on here again. Now we've gone through all of the financial projections and assumptions for your institution. We've just customize all the peer group information that we'd like to, and but we also want to customize our historical loss experience. So again, in the first test, we're looking at the peer group loss experience. In the second stress test, we are doing the same methodology, but ignoring the peers' experience and looking at our experience. So we want to define a baseline scenario for our bank and a stress scenario for our bank. By default, again, we use the most recent 4 quarters for a baseline or healthy period. If I scroll down here, I can see for this particular bank, pretty good, pretty healthy. And if we wanted to modify that, of course, we could. And so you don't have to have the same stress period for your bank as you do for your peer group. That's another enhancement we had for this this newer version of the stress test. But most of the time, if that was the stress period in your neck of the woods, they'll probably be some of the worst years for you, will probably be some of the same worst years for your peer group, as long as you build an intelligent local peer group. But we don't want to make that assumption for you, so you can customize the look back periods independently for your bank and for your peer group. Now, once you have finished customizing all these inputs, again, for your financial projections, for the peer group loss rates, and for your loss rates, whenever you make any of these changes, if you go back to seeing the results, it recalculates the entire test in real time in the background. So let's walk through some of the results here. I know we default to this executive summary page because it really has all the most important information about the stress test summarized in one table and a handful of charts. But if you want to walk through the detail of the results and not just a summary, we can click on detail. And the detail is really organized around those exact 3 steps. Remember, we talked about 3 steps for each stress test. The first one being step 1, reproject your losses by loan category. Step 2, use those losses to reproject earnings. And then step 3, use that to reproject capital. So here's step 1, loss projections. We now have our current loan portfolio right here, adjusted as we adjusted for COVID loans and any other guarantees. And then we're layering in these loss rates, right? Healthy baseline scenario loss rates, adverse scenario loss rates, and then severely adverse scenario loss rates. And then calculating in dollar amounts the net charge-offs that you might experience on an annual basis going forward if your loan portfolio were to perform, in this case, like your peers, right? Because these are the, we're looking at the detail for the first test, that peer group loss experience. So these loss rates here are your peers, but these dollar loss projections are your projections because we're basing these on your current balance. This is your current loan balance. So once we have sort of reprojected dollar amounts of charge-offs, as well as any gain or loss on OREO, and the reserve level that you might need to get to in all 3 of these scenarios, we use that information to reproject your income statement. So that's exactly what we've done here on this next page. Is we have built an annual, year 1 and year 2 income statement around, again, provisions for the losses that we just projected on the previous page, provisions, any additional provisions on top of the losses for if your reserve is inadequate and needs to get to a higher level going forward than it is today. We layer in the gain or loss on OREO and pretty much completely reproject your net income for year 1 and year 2 in all 3 scenarios side by side. And then finally, we take that information, the last piece of the puzzle is to reproject capital. So we take your current capital levels and ratios and we layer in those earnings, right, those annual earnings for year 1 and year 2 in all 3 scenarios. We also layer in any dividends. So we look at your current, dividend payout ratio and we sort of project that going forward, assuming that if you're losing money hand over fist, you're probably going to be suspending any of those dividends. And we can use that information to reproject your capital levels and ratios out a couple years into the future. And we do that exact thing, again, for all of the scenarios. And once we've done that, that's really the end of the line for the methodology. You can head back to the summary here and see exactly what we just went through, all kind of on one piece of paper. Let me zoom in a bit here. These are the net losses that we calculated on the second page there, or sorry, the net charge-offs and OREO losses, and that's used to reproject the net income in all 3 scenarios. And you can see, obviously, it plummets as the scenarios get more punitive. And then we have our current and our projected 2 years worth of capital ratios in all 3 scenarios, and I can scroll down here and see exactly all that. If I want to see what my leverage ratio is going to do in each of the years under each of the scenarios, I can do that right here, and I can sort of work my way across and summarize it all in this interactive environment. I want to touch on the reverse stress test for just a moment before moving on. So again, test 1 and test 2, very symmetrical in nature, just using different loss experience to drive the recalculations. But test 3, the reverse stress test, is a bit of a different animal. Again, remember, the reverse stress test is where we are working backwards to figure out what levels of losses we could sustain before we get into more trouble with our examiners. So, and that's exactly what we do here. So let's say the minimum to be well capitalized for a non-CBLR institution is 5% leverage, 6.5 CET1, 8% Tier 1, and 10%. You have to exceed all 4 of those minimum ratios to be considered well capitalized. So if you were to enter a very punitive credit environment moving forward, which of those minimums would you trigger first if you started to lose significant amounts of money? Well, that's the first thing we calculate as part of this test. Where's the bottleneck from a capital ratio standpoint? And once we have determined that, we work backwards to calculate what it would take to get to this number from where you are today. And in this, again, albeit large community banks experience, they would need to have net income losses or net losses of $171 million, and we back out taxes, and then we back out other revenue streams to calculate that they would need to sustain net charge-offs and OREO losses in excess of $300 million, or 10% of their portfolio would need to go down the tubes for them to no longer be considered well capitalized. And then, of course, it would be even worse or more punitive to no longer be considered adequately capitalized. And then in the worst of all worst case scenarios, how much could you afford to lose before they start coming in and locking the doors and taking the computers? The significant enhancement to the reverse stress test in this new version of our tool is this minimum capital, internal capital minimum target, where you can plug in any value you want here along this line. Well, I just plugged in 10.5% total risk-based capital. That's at CCB minimum, fully phased in, and figure out exactly what levels of losses they could sustain before dropping below this. Whether it's an internal target that you guys have, that's something that you have certain triggers at the board level that go into play once you drop below a minimum, whether it's maybe 10 or 11 or 12% total risk-based capital. You can play with those and run some scenarios from that perspective. And then we also have sort of a summary of the reverse stress test where we can see the max 2-year losses and then the resulting 2-year earnings or losses in each of those scenarios. Hold on just 1 second for me. Okay. And then heading back to the main page here. So now we've sort of walked through the entire stress test, all 3 of the independent tests, and exactly how the inputs play in and how the outputs are visualized in this newer interactive environment. Again, as I mentioned earlier, we have some other administrative tools. After you've created the scenario, you give it some sort of a name, maybe something more descriptive than that, and create it. And then, again, you can come back and you can save as many different scenarios as you like and access them in the cloud in the future. When you make modifications, you can resave the scenario or save it again as something new. There's no limitations on how much you use the scenarios. And while I realize our design here for this new interactive environment was very practical for modifying assumptions and inputs, and then seeing instantaneously in real time exactly what's going to move the needle, right? What impact those changes have on the stress test. But it's not so super practical for sharing this entire product as a whole, either externally or internally with the management team. So we allow you to export the results. You can either export sort of an executive summary or the entire full report. And once you do that, if you just export it to PDF, it'll think for just a couple seconds, and it will create an entire PDF of your whole stress test right here. And this is going to look more like, for our current credit stress test customers, this will look a lot like the output, the PDF output that you're getting now. And of course, you can also do that same export into an Excel environment as well. Hold on just one moment for me. And this is where I'm going to try to head back to the PowerPoint presentation. So bear with me just one moment. Okay. So now that we're back in the PowerPoint, I wanted to leave this PowerPoint some slides as a resource for new users and existing users. So some of the things that we just kind of went over are also not just in my on the browser I went through, but also saved in this PowerPoint presentation for you guys to take home with you. Again, this is where we're customizing the financial projections, customizing the loan portfolio for PPP loans, the ability to add in the internal minimums on the reverse stress test, and any additional projected capital raises, the ability to customize our look-back periods for the historical loss rates. And again, this is where we're reprojecting the losses, reprojecting earnings, and reprojecting capital. Let's see. So just a last note for our existing credit stress test users, we're going to have a transitional period here, so you don't have to worry. We're not going to turn off your old stress test tomorrow. For a while, you'll have access to the same page that you're used to running your current stress test. You'll still be able to run it exactly as you have in the past. You're going to retain access to all of the reports that you've already run. We're not turning off right now the stress test or deleting any of the reports that you've run in the past. Again, the new interactive tool has a lot of the same default values that you're used to seeing in your current stress test. It's just already run for you in that interactive environment the second that you log into the system. And again, if you export the new tool to PDF, you'll see a report and format that's pretty similar and recognizable to what you're used to, with just some added detail for historical losses and for your current portfolio. And with that, I will turn it back over to Sean.
Hey, this is David.
Thank you. Yep. No, thank you, David. I just want to make sure you got it. Thank you.
Yeah. Yeah, this, for the last few minutes of the presentation, I wanted to thank you, Steve, is to talk a little bit about the IntelliCredit portion of what we're doing with credit stress tests. As Sean alluded to, the conundrum kind of continues relative to community banks, what approach to take. I think the primary focus of that is concentrations, of course, particularly in CRE. We're hearing anecdotal information that regulators are already beginning to suggest strongly that stress tests be done the next time they're, as they say, in the shop. But again, as Sean alluded to, this is not highly prescriptive for community banks. We certainly think that some of the key reading tea leaves around this, as I said, is in the higher concentration areas, particularly in CRE or relative to capital. But also if you've experienced a lot of loan losses above your peer group, again, that has not shown its head yet in the COVID environment, but many are concerned that it will deteriorate somewhat in 2021 when regulatory relief expires, so to speak, and the stimulus begins to abate. Are you growing certain portions of your loan portfolio very quickly? And have you had some more sophisticated aspects of your loan portfolio that probably would merit stress testing? So at IntelliCredit, we kind of look at the so-called non-public perspective of credit performance and credit stress. And much of that is based on the presumption that we would calculate probabilities of default for you, which is an informed statistical estimate of a likely default, as well as a loss given default, which is a measure estimating severity upon loss, assuming a default. And the math is fairly simple. The product of these two is your loss percentage estimate. Now, net charge-offs was kind of the rule of the game, if you will, a decade ago in the last financial crisis, but we think that that's going to be expanded in many ways to include not just charge-offs, but also perhaps 90-day delinquencies, non-accruals, or any loans that have been designated for foreclosure or bankruptcy. The reason that is largely the case, we think, is because with now more capital in the banking space, there's going to be more of a focus on reserves, frankly, than charge-offs, which was the case, we certainly think, in the previous crisis. So again, just in simple forms, the way we look at kind of loan level or bottom-up stress testing, the methodology behind it is first we look at risk grade migration. We take risk grades or risk rating or risk ratings, whichever term you use, as frankly a proxy for both underwriting and servicing of your loan portfolio. And thereby taking that and segmenting your loan portfolio into either bands or loan types, and then assigning them in terms of balance distribution relative to that. And that creates a baseline loan estimate for you. At that point, you may be able to then begin to stress using Basel II assumptions such as a 1 in 10 or 1 in 25 year event circumstance that would allow, and it could be done in an economic or econometric, I should say, stress emulation, which is largely resembling the Fed's suggestion, or it could be done what some of us refer to as a parameter-based stress, which is a little more idiosyncratic to your bank's performance. However, when stress testing first emerged in the early Dodd-Frank era, in the early teens, it was kind of theorized as, oh, this is fairly easy to do, but it was in many ways a great theory, but with flawed practicality, largely because it presumed all underwriting and credit data points were current in real time, and we know that's not the case. It also almost implied that there was constant re-underwriting of the loan portfolio, which of course is not realistic, and of course all of that is very, very inefficient. One of the things we also would like to suggest is a very potent complement to the portfolio stress testing that Steve just went through and the enhancements of quick analytics, is to potentially companion your loan review with what some would call a sensitivity stress test of loans that are actually being looked at in the loan review process. Obviously, that would start with trying to take as much inventory as you have available in your loan portfolio on certain data points, particularly, hopefully, that have some accuracy and timeliness to it. This would obviously be extracts from your core, or it could be other spreadsheets or databases that you're using to monitor your loan portfolio or your loan process. Specific steps that would need to be looked at, I think, as we build this kind of companion sensitivity study, understand your portfolio concentrations, subsets, vintages, and hotspots. Here depicted are examples of that, of what the IntelliCredit Portfolio Analyzer can do for you. Again, we live in an environment that I think is most pronounced by COVID in terms of our need to subset our portfolios by FDIC types, or loan types, certainly concentrations, as we alluded to, either to average risk-based capital or the community bank leverage ratio. A client of ours in Nebraska said that they had 650% of their capital tied up in ag loans, but they quickly were able to use this process to indicate the benignness of that portfolio, thereby disabusing a regulator of potential concern over the high concentration of that. Again, nothing is probably more pronounced than the COVID legacy than the need to understand and subset your portfolios by industries, because we've got a very disparate and varied impact of COVID on different types of industries within our portfolios. That would certainly be a need to begin to build a sensitivity stress test with loan review. As Steve alluded to, IntelliCredit also has the ability to segment and identify your portfolio based on COVID effective loans or PPP loans, SBA, USDA, asset-based loans, asset-based lending loans. Again, that would be important to begin to understand where the various hotspots are emerging in your portfolio. A perfect example of that, again, in the post-COVID environment is we look on the chart to the left, which basically shows the whole portfolio migration of risk within the past categories, which really doesn't show much distinction of risk or migration within those past categories. But if you look on the chart to the right and just take a subset of the portfolio, which happens to be residential construction, that bell curve showing risk grade migration moving a bit to the right shows heightened risk in that particular subset. Again, this is part of the legacy of COVID, I think, the need for banks to begin to identify and segregate various hotspots within the portfolio and then presumably identify those as stress for stress testing purposes. Again, this would be an example of where you could take this and begin to compare a pre and post stress test scenario. These are depictions of what the Fed suggested in about 2012 would be examples that could be used. And again, this we think is very, very could be done very, very effectively with loan review. Why would we companion stress testing with loan review? Honestly, I think it kills two birds with one stone in that it has the efficiency built into it to leverage on the loan-by-loan, file-by-file engagement, whether it be external which we certainly can do, or whether you have internal loan review processes of your own. It also is arguably the most real-time perspective on a borrower's current circumstances, which offsets some of the risk of relying on potentially out-of-date initial credit underwriting data. It could be seen as a variant or, frankly, an extension of the various sensitivity analysis or projections that are often applied at original underwriting of a prospect or of a customer. And I think combined with the typical charts and graphs that come with most loan review presentations, these are issues that would be excellent add-ons or value adds to the board, management, and to the regulators. So with that, we certainly hope you would see this as a complement to everything Steve walked through in terms of portfolio level stress testing, and that's what we are all about at IntelliCredit, is complementing that aspect of it with more loan level or transactional credit stress testing as deemed appropriate by your bank or financial institution. Sean?
Thanks, David. Yeah, so just as a follow-up, a couple things. One, we'd certainly encourage you, if you'd like to go through your portfolio credit stress test through Quick Analytics, we'd love to take you through that. As David mentioned, there's additional types of testing we can perform for you if that's what you're looking for. But I want to overly just, kind of broadly emphasize, we always think our portfolio stress test is an easy bar for you to demonstrate to your regulators that you are proactively prodding and searching and doing some risk, credit risk management. So we think, if nothing else, it is it's a very positive step to demonstrate that you're even though you may not be or need or feel like you're going to experience any problems, that you are still evaluating this should something come your way. So we think it's one of those bars that are kind of easy to hit and almost is a missed opportunity to not take advantage of it. So as we go to questions here, it was just a reminder that this is something that you can incorporate into your credit risk management very easy. And then, as like I said, as you're thinking about scheduling your loan review for next year, certainly consider that as well. Okay, so whoops. So just a couple of questions we've gotten in. David or Steve, before we take these questions, anything you want to add?
No, I'm fine, Sean.
Okay. All right. All right. So we did get a couple of questions in. I know one. Let me get back to these. Bear with me one second as I pull these up. So the first question is besides peer and bank historical loan losses, are there any other assumptions available, such as economic indicators? Steve, do you want to take that one first, and I'll give my answer as well?
Sure. As we don't have other economic time series that are built into this tool. One of the things that we found is for an individual community bank trying to find economic time series that are really going to match your individual loss history over any particular period of time, especially at the loan category level, can be pretty challenging to do. A lot of the times where we see those economic time series being required by regulators when doing, whether it's stress testing or, for a CECL, like a life of the loan CECL type analysis, that works very well for very large banks that have a huge sample size of loans at the by category, or even a huge sample size of losses, right? But for smaller and regular normal sized community banks, that when you get down to an individual loan category, the sample size you might have of total loans in that category, and especially the sample size you might have of actual losses that you've experienced over the recent past, may be small or may honestly be completely zero. And that when that's the case, no, I guess no amount of economic data is going to allow you to modify a 0 to something, some multiple of a 0 to get a more rational view. So while we do think if you can, sort of bring economic trends into the analysis and you find some correlations, you can certainly do that. But a lot of times we found is that looking at the peers' experience as a way to sort of thicken your sample size, so to speak, is a better approach for a typical community bank than trying to find some of those maybe very non-existent trend correlations between economic series and your actual loss experience. But Sean, we do have a separate tool for that if you want to mention that, Sean.
Yeah, I was going to say, and then, two things. One, I was going to say, I think for those kind of econometric things, it might be, kind of relates to what David was saying at the loan level, you might be able to incorporate that into some type of sensitivity analysis. But then also we will be introducing a credit research page where we are pulling in economic data from the St. Louis Fed's Fred site that then you can run research on and comparisons to different loan portfolio topics, so you can try to define or drive and see if there's any correlation. So that will be coming with the first quarter or the year-end release of call report data in February. So it will be a step in that direction. And then again, as I mentioned, at IntelliCredit, David probably can put together something to address that on a more institution level type of analysis.
And Sean, I would say this, that it may on its face may sound counterintuitive, but I've always felt that running complementary and concurrent stress tests from different perspectives, whether it be econometric or parameter-based or portfolio-based, loan review sensitivity-based, is not anything wrong with that. In fact, in many ways, it gives you more protection from being kind of hung out, if you will, if one particular stress test is too alarming.
Great. I think that's it for questions. So again, we want to thank you all very much for attending. We'll leave this screen up. We encourage you to again, call us and schedule a time to review your portfolio, quick analytics credit stress test. Consider us, or we'd love to have the opportunity as you're thinking about your 2021 loan reviews. And if there's anything else we can do or just help you with, we are here to help and would welcome an opportunity to discuss your situation with you. With that, thanks again for joining us today, and we'll look forward to speaking with you soon. Bye now.